Welcome to the show, Victor. It's absolutely awesome having you on Wise Wealth Podcast. Thanks for joining us.
Thank you for having me.
So I suppose everyone's sitting here wondering, who are you? What do you do? If you can give us
uh,
an insight into that, it'd be awesome.
yeah, I sometimes wonder myself. Well, uh, I mean, you might think this funny, but I tell people sometimes I'm an unpaid psychiatrist to CEOs, and the unpaid bit is well, because I work in the M&A business with growth companies, where typically we're doing deals that are kind of 50 to 100 million plus in value.
Okay.
So they're pretty transformational events for CEOs. But
Yeah.
around that, it really does feel, and sometimes is the reality, that I'm an unpaid psychiatrist to CEOs, because for the most part, you're talking about people who maybe even in their late 20s or 30s or 40s, right? And they're doing their first ever exit. And, it's the one opportunity some of them will ever have for creating kind of generational wealth. And I don't mean to big it up too much, but it's really a life transforming experience. I mean, it would be a great privilege of anybody's life to be able to do one successful exit.
Yeah.
And we read about, the one in a million or one in a billion that might do several. But the vast majority of people who start a business and work at it for 5-10 years plus dream about being able to do an exit. And that's where somebody like me comes in to help make that happen.
Yeah. So I suppose that's all. Is that all wrapped under? Is it called DAI? DAI Magister? Is that how I pronounce it?
Yeah, that's right.
Under the
DAI
investment.
Magister. It's my third firm.
Okay.
So yeah, I made a specialty in a weird way of starting investment banking firms. So this is the third one. The first one was a company called Broadview that was acquired by Jefferies, and became the TMT, Technology Media Telecoms group within Jefferies. And then I started another firm called Arma Partners, which actually itself has just been acquired this year.
Okay.
So yeah, nothing to do with me. I was there for 5-6 years and helped build it up. And then it sort of became a rerun of Broadview. I had, I joined Broadview, and it was 12 people, and we built it to 500.
Wow.
And so I wanted to do the 0 to 10 person bit
Yeah.
of the journey, right?
Yeah.
And then, Armor got built to a few dozen people, and it was sort of a rerun of the Broadview journey. So I felt like I'd been there, done that. But the honest answer is I wanted to start a second firm back then because I wanted to prove that the first time wasn't luck.
Okay.
Nobody other than me cared about this, but I wanted to prove to myself. I figured if I could go 2 out of 2, then the
Yeah.
first one wasn't luck,
Yeah.
or at least nobody could claim it was luck. Now, of course, there was nobody claiming anything. So this is
Yeah.
just the one part of my brain talking to the other part. But
Yeah.
people have different motivations for starting a business. And
I mean, it
this
is
third,
rare. It is rare. Some people have been struck by lightning twice.
well, yeah, I mean, the thing is, you do get better at it. And so I started this third firm, which was originally Magister, and that got acquired. Actually, only 2-3 years ago by a larger company, DAI. But I'd started this third firm really accidentally. It's like having an accidental third child, for
Yeah.
anybody listening, right? I personally have been there, but it sort of grew out of I was a venture partner at a large venture capital fund, and people started saying, can you help me with this deal? Can you help me with that deal? Again, as I said, these are life-changing events for CEOs. And so once you build a bit of a reputation being helpful doing it, then it's not surprising, I suppose, that people, want to get that kind of specialist help when they're doing that. Anyway, so, CEOs would say, can you help me with this or that? And so I ended up needing to hire people and turned into a firm. It was not really the original intention because, as I said, Sam, I was 2 out of 2. I didn't want to go 2 out of 3. So I sort of, I thought, let's preserve the track record,
Yeah.
one
Yeah.
side of the brain telling the other. But anyway, here we are. And the third one as I said, was the majority of it was acquired 2 or 3 years ago. And the idea was to just be able to add more resources, to be able to build the business a bit faster, also with lower risk to myself. So I went through the same calculus, the same journey, the same emotional journey that I have been helping so many CEOs go through.
Yeah.
So it was weird being on the other side of the table from somebody like myself, right? And, actually doing it myself was strange. So I quite enjoyed it, but I lived that kind of fraught. Do I not do I do it? Do I not do it? All of that. It's an emotional roller coaster. I mean, we look at it in terms of numbers, value and price and terms and whatever, all the technical stuff, but it's a huge emotional journey for
Yeah.
people. So
So I
anyway,
suppose now, I mean, you've been there, sort of done it, got the t-shirt, I suppose.
yeah, yeah. So
It's,
yeah, I don't know if it's made me a better advisor or not. I'd like to think so, but it's probably a strap line I tell myself. But in any event, I lived the experience.
so how many sort of mergers and acquisitions, I suppose, like is your company doing, say, in a normal year?
Oh, I mean, it really does vary. So personally, I counted this a year or two ago because somebody asked me the question,
Yeah.
and I've worked on 130
Wow.
myself personally, and that's over a fair few years.
Yeah.
So in any one year, it's can go from a handful to 10 to 15, probably at the upper end. I mean, the team's not. I deliberately didn't want to have a team that's now 100 people again.
Yeah.
So, but I mean, at Broadview, what we were doing, we must have been doing close to 100 in a year. I
Wow.
wouldn't be surprised. Yeah, it was the biggest M&A firm in the world, working with technology companies at the time. So that's a lot to do. I
How does
mean,
that
that's
even
a lot.
work then? Do they come to you and say we want to do an exit, and then you try to match them up with a suitable sort of buyer?
Well, I'll tell you what usually happens. Yeah, which is a little different than people think.
Yeah.
What you said is exactly what people would normally think, and I can completely understand it. The way it usually happens, it's a lot messier than that
Okay.
in a good way. Okay. Why is it messier? Well, because if you build a company to a certain size and you're doing something that makes some difference in a market space or in a geography, usually you get on the radar screen
Yeah.
of buyers. So very often, people we get involved in helping have had an approach from somebody. Now, maybe
Mm.
it's serious, maybe it's not. Sometimes it's several. Sometimes, they are going to be raising a next round and
Yeah.
think, well, okay, I've had a couple of approaches from large buyers, didn't really make sense. Now I'm going to be raising money. Market is quiet, right? Valuations are down. So I'm going to give away 20, 30% or more of the company. I use the word give away. Of course, you're getting money for it, but, still. And so my ownership stake goes from this number down to a meaningfully lower
Yeah.
stake. Is that something I really want to do? I end up with, I don't know, 15% of the company, I'm just making a number up, 15%. I've raised a chunk more money. I'm now re-upping for another 5+ years. I wonder if what these other options might entail. And so sometimes you oftentimes respond. You might literally pick up the phone and talk to one of the buyers that might be interested. And all of a sudden, you're in an M&A process.
Yeah.
Not really of your own choosing. And some of the buyers are very obvious. Yeah. Others you hadn't really thought of. And
Mm.
so buyers are on different clock speeds. Some want to move very quickly. Others that you might really want have got, 5 internal gates to go through. And all
Yeah.
of a sudden, then you're going from well, I'm just going to entertain interest and maybe see what's out there to, okay, I've got 4 or 5 different buyers, different clock speeds, different requirements, asking me different things. And by the way, this is going to change my life.
Mm.
I better not screw it up.
Yeah.
Yeah. Now, there's a very professional overlay to this story, which is a board meets and decides that they're going to sell the company, and they, decide to talk to a few advisors, go through a qualification process. That's the normal linear,
Yeah.
kind of hygienic thing. But the messiness underneath is usually the reality. Usually we get involved midstream, and there's a degree of controlling the chaos a
Yeah.
little bit, because imagine this: you own 25% of a business.
Mm.
You realize it could be worth 100 million.
Mm.
You realize that you're not paying much tax on the first chunk of money.
Yeah.
You do a very quick calculation, Sam, of what it means for you,
Yeah.
right? All of a sudden, you're beyond the paying off the mortgage and school fees,
Mm.
and you are immediately into grandchildren territory.
Yeah.
Yeah. Or nothing. That's the calculus usually
Yeah.
I end up stepping into.
Yeah.
Right.
The
So
generational wealth creation is quite a strong message, isn't it? If you can get to that stage of going, when is enough for me to say now's the time?
some CEOs do exactly that. I've had CEOs who tell me, here's my number.
Hmm.
Yeah, because they worked it all out. There's
Yeah.
others who are, and I say this in the best possible way, kind of deer in the headlights. Like,
Yeah.
oh my God, what the hell do I do now? Sorry, I can say hell
Yeah.
on this podcast, right?
No, it's fine.
Yeah, okay, fine. Um, and others, the way they deal with it is they will kind of jump on it, treat it as a business process.
Yeah.
It's just like any other business process, right? And be able to separate themselves a little bit from it.
Yeah.
Um, Usually, it's the most logical, most mathematical thinking people that are the most chaotic when it comes to this. Maybe not surprising, right?
Yeah.
Because it's like, okay, it's this, they're not behaving the way I expected them to behave. Oh, I can't control. This is the thing. You can't really control this. And then all of a sudden there's an enormous amount on the line. And I say this from the CEO's point of view, because a lot of the work we do is for boards. Yeah, we
Yeah.
actually get hired by the board of a company.
Yeah.
And so it's the investors typically who do it. But I tell all the investors in any board, without the CEO driving this, nothing's going to happen. They can kill it or make it happen,
Yeah.
because they're the ones talking to buyers. They're the ones selling the story. They're the ones that buyers want
Yeah.
generally as part of a package. And so, if they do a brilliant job, everybody wins. If they screw it up, if I put it
Mm.
that way, you probably will never know that they screwed it up because you're not in the room.
Yeah.
So they also have to have a leap of faith, to trust the CEO in a job that, or a role that he or she 99% of the time has never done before,
Mm.
has never really been able to prepare for. You can't really go to school. I used to teach a class on preparing for an exit, by the way, but so actually you could have gone to school, right? Yeah, yeah.
That's
But
awesome.
but trust me, having done it, it doesn't. It's not, you can't prepare somebody for this. This is a lived experience moment, and so. And the problem you have is that, CEOs are expected to be able
Mm.
to deal with a whole range of different things. And all of a sudden they're confronted with the singularly most important thing in their business life that they're totally unprepared for.
Mm.
And there's the proverbial 100 million on the line, right?
Yeah.
That's what amps the stakes. That's why I've been doing this for 25 plus years, because it is in its own way addictive in the best sense of the word.
Yeah.
A
I think it's
privilege.
really I think it's really interesting. Now, to be honest with you, I'm only 32. I'm the director of a company that's within the seven-figure range. And it was only over the last few years that, like you said, you come onto the radar of people that want to acquire you, and then they start throwing suggestions. And for me, I've just sort of batted them away
Yeah.
because I started this company back in 2012, and I sit there and I think it's sort of it's sort of like my child. that I started. So I think, there's quite a lot of an emotional
Yeah.
decision in that sort of aspect as well. And I think it's, it depends as well, what is that? What does that look like when they want to acquire? Is it a small stake? Is it they want to take over majority? And yeah, it's quite interesting because pretty much
Well,
everything that you were saying, I can relate to from seeing some of these offers in the past.
yeah. The other thing is that there's the intangibles have a huge effect on the outcome,
Mm,
and on the most basic things like the price. I
mm,
mean, you can do financial analysis and do the forecast and all of that, but having been in so many of these rooms, the way in which a CEO answers a certain question, right? The inflection or tone in their voice. For example, I'm a buyer. I'm going to pay 50 million for this company. I want to know, in quotation marks, that you are seriously committed to making this work after I acquire the business. You might say something or not say something in a room that deliberately or inadvertently gives people on the buyer side less confidence.
mm.
Now, you can't mathematically trace that influencing price, but I can tell you that the
Yeah,
buyer will offer the lower end of the range,
yeah. It's the
right? And
confidence, isn't it?
it's the confidence.
Mm,
Conversely, you go into the room and you oversteer the other direction,
mm.
right? Towards bluster.
Okay.
And I'm thinking, I don't know if I really believe him.
Yeah.
And so your analyst, let's say I'm the buyer, my analyst, we're reviewing things internally, and I'm just going to guide them to kind of haircut the forecast. Now, there's a conscious bit, which is I'm not sure the scenario makes sense. There's also just the unconscious thing. Sam is bullshitting me a little bit.
Yeah.
He's over. That's can't be. So there's that kind of in between where you as a CEO establish enough credibility that they think, oh, these numbers are completely achievable.
Mm,
Establish enough certainty. I know you're committed. Establish all of the baseline things so that, of course, I have a range as a buyer. I'm not going to pay any price, but I go to the top of my range because I really, really want it. Right now, the range can be 25%. Right. I can tell you because somebody asked me this a few weeks ago, the myth around doing these deals is that, the difference in price between the winning bidder and the second bidder is like 5%. That is a myth. On
okay.
average, it's oftentimes 25% or more,
Wow.
right? I've seen in cases where it's 50%.
That's crazy,
And
isn't it?
the reason is because they're not buying an asset, right? They're buying a future opportunity.
Mm,
And it's hugely influenced by what they forecast, how confident they are, etc. How much they need you. All of those things are ingredients that go into their analysis, a buyer's
mm,
analysis of what the opportunity is. And if and because the price delta is so significant,
mm.
that raises the stakes enormously for that proverbial moment in the room I was talking about earlier. That is all the messiness. I mean, it just gives you a little insight, the
Yeah.
messiness around these. And the thing is, it would be kind of, funny and we'd have a laugh about it if the stakes weren't life changing.
Yeah. Yeah. It's very interesting that you're almost like a psychologist, aren't you?
That's why I started by prefacing saying I'm, an unpaid psychiatrist a lot of the time. I mean, now
Yeah.
there's a whole other part to the job, which I've been drilled in and I suppose I take for granted, which is you have the rigor to get
Yeah.
these deals over the line. But how to play things is incredibly important. And of course, you always have to avoid a buyer feeling played.
Yeah. 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 I think it's I always heard the saying that for a good deal to happen in a merger or acquisition, both parties are to be unhappy. That's what I heard. Is that true?
Yeah, yeah, there is truth to it. There's another way of putting it, which is I don't know if you like steak.
Yeah.
Good. Well, so you will know that a steak that is rare to, well, medium rare, still sizzling,
Yeah.
right, is incredibly appetizing. A steak that's fully cooked straight through and cold is very uninteresting. And so the quote perfect moment to sell, which nobody ever by definition knows, is when their proverbial steak is, not fully cooked, still sizzling, and therefore there's real opportunity in future. So in that sense, you could look at it and say, well, I sold, quote, too early.
Yeah.
Yeah, it wasn't completely done. But of course, once it's done, and you say, well, now I'm finally, after a decade, ready to do a sale, usually the business is not growing that quickly. It's the proverbial fully cooked, slightly cold steak. And it's a lot less attractive. So when you say that both parties coming away dissatisfied, I mean, we always look at it from the seller's point of view, because that's all we do is work for CEOs and boards selling companies. We never work for buyers. So, from that point of view, you would always be selling when it's not well done.
Yeah. No, it's not too well done when it's still in its
Yeah.
cooking, so to speak.
And by definition, you'd say, oh, I could have waited. Of course you could have waited.
Yeah.
So in that sense, you could be, quote, dissatisfied. But I tell you that otherwise, that's just mythic, because, by the time you wait, it's not interesting.
And I suppose from your perspective, do you work specifically in certain regions, or are you working globally on these? What sort of
Yeah, I mean, you asked a little earlier, and I didn't answer the question about how people, engage us. And because it is a confidence and trust business at the end of the day, we do a lot of outbound marketing, but a lot of times people will find us. And I don't mean that it's by appointment only or anything, but you kind of have to check the person out and know that it's, you know what I mean? It's a pretty big decision to make, and we get that. So we've concentrated in certain areas as a result. I mean, I've done now, as I said, 25 years working in Europe. Almost all of the deals I've worked on have ended up being American or international buyers, just because the deal values are fairly high, multiples of performance are fairly high, and usually it requires international buyer. About 5 years ago, we started working in Africa, interestingly enough. And so a large proportion of the work that we do is doing fundraisers, large fundraisers, and M&A increasingly in Africa. And the reason for that, sorry.
So interesting you're saying that. I did a podcast earlier today with a Swiss non-profit, and they were in Nigeria and doing lots of work there. And then it was only last week that I was talking to a venture capitalist of 300 million. It's also doing large amounts of investments in Nigeria. And you're the third person in a week that's spoken about, investing in Africa. And I find it crazy because it's not something you hear much of. It's not really on the radar. Clearly, a lot of people in business there.
No. So 5 years ago, we worked with a Kenyan company called Cellulant that was a payments company, and they raised almost $50 million from an investor called TPG. And somebody a week or so later said, that was the biggest growth equity round that's ever been done in Africa. And I said, oh, come on, you got to be kidding me. I mean, 50 million euros, it's a decent size round in Europe. I mean, you might notice it for a morning, and move on. In America, it wouldn't even probably get reported. But I realized, therefore, that we were getting involved literally on the ground floor. And when I moved from the US to London 25 plus years ago now, it was also the ground floor.
Yeah.
I mean, growth companies, tech-driven companies, different parts of the space, whether it's deep tech or tech-enabled commerce in and around Europe, was like very few and far between. It was mostly services companies implementing American software products for the most part, or hardware. And the industry has obviously grown across Europe and in the UK out of all proportion. So I built my career on the back of the growth of that industry in Europe. So the pattern recognition kicked in. When I was in Kenya and in Lagos, and I thought, oh, this is the ground floor. This is what it looks like.
Yeah.
And that's what spurred us to, now we counted it. We've raised almost $1 billion in money so far for African businesses, all for international investors. Yeah. So we went kind of deep. So when you said, what do you focus on? I mean, it's normally the heartland of the work I've done for many years with European companies, typically getting international interest. And then now a significant minority of our work in Africa, which in 25 years, I hope will look in some way similar to Europe, or at least we'll have the growth in Europe. And of course, we build a whole leg to our business doing that.
Yeah.
It's not easy.
There's always this question I always wanted to ask, and I think you're the right guy to ask. I think it's great. I actually learned something as well. It's when you look at business multiples, I know it's probably going to be a far-fetched thing to ask, but what sort of I see some people only getting 2 to 4 from a multiple. I see some people that are 10 plus on their multiples on acquisitions. What is what is, I suppose, from your perspective, what is an average multiple where you're getting lowballed, or actually you go, that's something that I should really consider?
Yeah. So a lot of the deals we do end up being multiples of turnover or revenue rather than profitability. And simple reason is the companies are growing too quickly to have a serious level of profitability. And when you're multiplying revenue, you're effectively predicting forward profitability at the end of the day. For businesses that have a fairly high level of recurring revenue of one form or other, SaaS businesses, others, which is software-driven business in one form or another. I mean, the multiples have kind of stabilized in the mid to high single digits. So 10 times revenue is punchy in the market today, but typically if a business is growing reasonably well, 5x plus is normally doable. And that can be 100 times EBITDA, 100 times, right? Because of businesses very marginally profitable, but obviously people are not valuing it based on that. The spreads are, I mean, in terms of revenue multiples in the work we do, you can have slower growing hardware businesses somewhere between 1.5 and 2x. And, even one thing that we're currently doing, it's still at 20 times revenue. And then you graduate to a whole different bracket, which we're seeing with AI businesses, where it's, I know it's unbelievable, but it's value per engineer.
Wow.
So the median today, if you can stay on your chair, is $10 million per engineer.
Well, I may as well start a company tomorrow and get 10 engineers. Off we go.
So people have said that. And of course, a lot of them don't get acquired. So, there's a lot of people, including I probably would say, well, let me try and get 20 engineers together. And you know what I mean? If it's quote that easy, of course, people are only doing acquisitions of businesses, obviously, which they think really will move the needle for them. But those that are getting acquired, it's, it is a quote unbelievable number. And the reason it's, I told you the number per engineer is because a lot of companies, particularly in generative AI, have almost no revenue.
Yeah.
I mean, OpenAI, which has recently been in the news, you might have read, is not that big a company.
Yeah.
in terms
Yeah.
of revenue size. So, and they're valued at $80 billion. So,
I suppose it's
with
the
seven,
buzzword at the moment as well, isn't it?
yeah, with 700 people. So, DeepMind, even years ago when Google bought them, was not that big a company. So, yeah, you go through these moments where you get, quote, unbelievable valuations really based on raw capability
Yeah.
as much as anything else. So you get standard business multiples that are influenced up by growth.
Mm.
And then you get into this Shangri-La
Yeah.
magic moment.
Yeah.
I don't know, but it's yeah, it will stabilize. But
Yeah. I think
in
it's
a way, I tell a lot of AI companies it's probably better to be acquired before you actually have to do the hard yards of building a company. I mean, no disrespect, but maybe I'm biased, but at $10 million per engineer, if I have interest to be acquired, like who the hell would actually want to go do all the hard yards to build a company if
yeah.
there's a potential deal on the table that's really based on raw capability? I would think of that as a get out of jail card.
Yeah. It's
You
almost
know,
like a talent acquisition, really, more than actually a company.
it's you're not wrong. But
Yeah.
look, that's only available for a very small number of companies, but it's happening.
Mm. Yeah.
So anyway, so you get very different approaches. The earlier you move, and also the greater the need
Yeah.
for a buyer. So one of the fallacies, if I put down quotation marks, about looking at kind of what are the business multiples is, by definition, it ignores the depth of need in a
Mm.
particular buyer. Now, they're not going to pay 5 times, market prices for something just because they quote need it. But a lot of times, Sam, deals happen because a buyer, very large buyer, their business unit is missing its numbers, for
Yeah.
example. So they're doing acquisitions in order to kind of
Increase
bring
their
their own business unit back. Right now, that's why they want to do the deal, and the need is therefore very, very high, and so they're willing to go to the upper end of a range
yeah.
if they can, quote, justify it. And buyers are incredibly bright people, so they will just judge the need up to a certain level. So you can get a fairly widespread in terms of the multiples based on the requirements that a buyer has at a particular point in time, which goes back to my earlier point that you can have one buyer at price 100 and the next buyer at 70, for example. And that's because the person at 100 really, really needs it.
Yeah. 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 It's a
And for
big.
them, it's worth 200. So at 100, it's worth doing.
So I suppose from your perspective, I think we've covered so much stuff here about mergers and acquisitions, and I think it's a
Sure.
massive eye opener for anybody that's looking at either acquiring or being acquired.
Yeah.
Where do people sort of find out more information about yourself and your services of how they may be able to reach out?
Sure. It's at DAIMagister.com. That's Magister, all one word. So and yeah, well, I mean, I've been kind of, in the same corner shop for more than a couple of decades now. So I probably will be at this corner shop again tomorrow and the next day. I'm not going anywhere.
Amazing. Well, honestly,
Thank
thank you
you.
so much for your time, Victor. It's been amazing and some really great insights. Really great insights. Thank you.
Yeah, happy to help. Thank you.